It, as such, it funds and facilitates growth, it pays salaries, it pays the members dividends, and it also caters for repairs and maintenance and every other thing that the credit union requires to be done that would need funds to do so. So it's an extremely critical function. The thing about it, though, is that when you're elected through a political process and not through a set of interviews and qualifications and experience. As a result of that, you are now, therefore, responsible or have a responsibility to yourself and to the criterion that you serve to familiarize yourself with, firstly, the loan policy, because you need to know the terms and conditions under which you can approve the loans, because remember, you are the authority on loans. But the policy, however, is set by the board of directors. So you need to familiarize yourself with that so that you understand your role and function. You'd also need to understand the bylaws of the credit union, and it will also be very helpful for statutory committee members to familiarize themselves with the Cooperative Societies Act. Having said that, I know that some of you may have been involved in the credit union previously. Some of you might be, new to the credit committee, and as such, I just want to say that for those of us who are familiar with the roles and responsibilities of the credit committee, feel free to add or query something that's said. And for those of you who are new, it really is a fantastic journey and a fantastic experience to be part of the credit union movement and, in particular, the credit committee. Now, as we said, training for credit committee members or prospective credit committee members must be an ongoing thing. And I really want to stress that because the economy changes, situation changes, the way people are employed also changes. So, for example, like right now, you have a lot more people who are contract employees. And based on your credit union's bond, especially those credit unions who are in house credit unions, expand or have external members or members who were previously internal, meaning employed with the company, but have left and are still members, the way in which you lend to these members may be a bit different to those members that you have salary reductions for and stuff like that. So I'm saying that is very important as credit union members, at credit committee members, sorry, to avail yourself to continuous training. Having said that, I think it is also important for credit committee members to understand that while they are the sole authority on granting loans, they must act within the loan policy as set out by the board of directors. And sometimes, there is some confusion about that because sometimes a credit committee might, be of the opinion that as the sole authority on loans, they can make certain determinations and sometimes might be tempted to go outside of the policy. And as such, that is not something that a credit committee member should do at all. As a matter of fact, even for things like a waiver on a loan, a waiver on a policy, really all a credit committee member can do is actually recommend a waiver, and that will have to go to the board for the approval. Of course, in most circumstances, it is approved, but in order to waive a policy, you really need to go to the board to do so. So while you're the sole authority on loans, as I said, it is within the ambit of the loan policy that's set out by the board. Um, the only difference to the authority of the credit committee is when it comes to loans to those of you who are fortunate to be elected to the credit committee. Because as a statutory committee member, be it the board of directors, the supervisory committee, or the credit committee, your own loans are not approved by the credit committee. So you cannot approve the loans for your peers. For example, on the credit committee, you can't approve a loan for a board member or a supervisory committee member. All loans for board, credit or supervisory committee members must be done through what you call a joint sitting of the board, the supervisory committee, and credit committee, and the approval is done through two-thirds of the members agreeing to grant the loan. Now, some people may find this a bit onerous. Of course, let me just state one adjustment to that. If the loan is being approved within your shares, sometimes credit unions don't necessarily require that. But as long as it goes outside of your shares, most definitely it has to go to the joint sitting of the board, credit, and supervisory because of the strategic positions that you will be holding in the organization is extremely critical that all those loans are properly vetted and ensure that the right authority or the right body that's charged with the responsibility of approving the officer's loans is the committee to approve it. So I just wanted to mention that that is the only exception. Now, granting loans is not a perfect science. And as such, we will all make mistakes from time to time and grant a bad loan. It's not to feel bad if you've granted a bad loan. However, you must have limits to which that is done. And that is why training is so important. Under normal conditions, you'll probably not want to have um, a loan delinquency of more than 5%. Sometimes it may go a little above, but anytime it's going above, you need to make sure and bring it down. I know that as volunteers, you all would sometimes not be as familiar with the delinquency policy as, say, for example, members of staff. But I think it is a statistic that you all should really review on a monthly basis because the level of loan delinquency reflects to some extent your performance. And if it is the loan delinquency is high, it is as a result of poor loans being granted. And if it is low, it is normally as a result of good loans being granted. Now, I also want to stick a pin here and say that if you have zero delinquency, it might also mean that you're simply not lending enough, that you're afraid to lend. So there must be a good balance between what you can lend, between the loans that you grant and the loans that you choose not to grant. In evaluating a loan application, though, we as credit committee members must be very wary about our own personal biases and use the tools available to us to evaluate a loan proposal appropriately. And then normally about three tools that I use. Firstly, there's the loan application, then there's the loan interview, and then we use what you call the 5 C's of credit to do the evaluation. Now, a little about the loan application. The loan application form is really where you meet the member. The loan application form really has to tell you what you need to know about the member in order to make a credit decision as to whether you should grant the loan or not. So as a result of that, you have to have the demographics because, say, for example, you need to know the person's age, you need to know where they live, you need to know where they work, you need to know if they're permanent, if they're temporary, if they're contract, you need to know their salaries, you need to know their assets, their liabilities, and you also need to have credit reports on the individuals. Now, I'll tell you why these things are important. All these things are important because you have certain parameters within which you can lend. So say, for example, if I am 58 years old and I come in for a loan that takes me way beyond shares, and I will take, let's say, 7 years to repay the loan, and I retire at 60, then it is important for you to know my age because if after age 60 I would no longer be employed, then you would need to know whether or not the loan I'm applying for is a loan that I can continue to serve after retirement because my income and my personal financial circumstances would have changed. Similarly, if it is that say, for example, I'm working in an industry that is experiencing some difficulties, those are things that you need to know. If it is on the application form, you have a situation in which, let's say, you find the person's address, and normally an application form, you not only have where the person lives, but you have how long they've lived and you have previous places that the person have lived. So the reason for that is if you're going through an application form and you see that someone is living in one place for the last 25 years, that kind of reflects a certain level of stability. If it is, though, that every 6 months I'm changing my address, then it sort of sends a message that maybe I'm not so stable, and it's quite possible that I'm leaving a number of different landlords wanting for their rent. So while some of the information may seem a bit onerous, I think it's important to have adequate information on the loan application form in order to allow you as a credit committee member to make a good informed credit decision. Assets and liabilities, most important. If it is on a loan application form, and I'm just discussing these things with you, this is not a training program, but it's a program, it is a discussion so that you have a good sense of the things that you would need to do and to be looking at once you are on the credit committee, but it cannot take the place of this discussion cannot take the place of a training session. So I don't want us to walk away getting that feeling at all. Going back to the assets and liabilities, sometimes we see people driving around with a Mercedes Benz and living in a well to do area in a big house. But if it is that, say, for example, my house is worth, let's say, $1 million and my car is worth $500,000, that's 1.5 million. But if it is, I am owing about 1.6 million, then my net worth is really a negative net worth of 100,000 because I'm owing more money than I actually have in assets. And so therefore, for someone else who simply has a car that is not so expensive, that's fully paid for, and 30,000 saved in the credit union, that person actually has more capital and more net worth than the person that's driving the Mercedes Benz. And so that's why having a sense or complete knowledge, and as much as possible, of the person's assets and liabilities are important, because it's not just what's before you, it's also the analysis you'll be doing on the application form. So the other thing is credit reports and stuff. It's important to have a sense of if a member is servicing all their loans according to the agreement with other lending institutions. Reason being is that if he or she is not servicing the loan at another institution, chances are they may not service the loan with you also. So those things are also important. The other tool that you use outside of the loan application form is the actual loan interview. Now, the loan interview has generally has about 6 steps. You really need to plan what you'll be asking during the interview. It's very disquieting when someone comes in to be interviewed for a loan because they're already feeling, well, boy, I have to come before this credit committee at 5 and pour out my heart to them and expose all sorts of things. And when you go, the credit committee is not prepared to do the interview with you. They're now asking questions. They're saying things like, because you all are familiar with each other, so you all are saying, boy, Harry, boy, how much, where this man working again, and where's the income? And the thing with the car, you check that out. That is not the time to be doing those things. You do those things before you meet the member. Because once the member comes in, remember, this person wants a loan and is feeling fairly vulnerable, having to be interviewed by 5 of their peers. So you need to plan exactly what you will be asking during the interview beforehand. You also need to establish privacy and confidentiality. You don't want to be interviewing the people and right in a room where you're interviewing them, there are 2 or 3 people otherwise that have nothing to do with the credit committee sitting and having a discussion or working on something else and saying, it's okay, I'm sorry, we don't really want to disturb you all, we'll be quiet. That's not very comfortable for a member because, the person is in a position where they already have to divulge a lot of personal information to five of their peers. They really may not feel as comfortable with other people around who have nothing to do with the approval process. So to establish privacy and confidentiality, very important. Now, what I discussed earlier was privacy. Confidentiality is the other one. Being credit committee members, you will be exposed to people's personal financial circumstances, and as such, it is not something to be discussed in the kitchen or on the workplace. It's not something to be discussed in the bars when you're living and you're chatting with your friend. That is not something that we do. So you need to treat the members' information as sacred, because it really is. Because you wouldn't want that to happen to you if it is the situation was reversed. You need to show a genuine interest in the applicant. Remember, this is your fellow credit union member just like you. And who knows, next 2, 3 years, they may be on the credit committee or even on the board of directors, right? So show an interest in them. You need to ask the relevant questions that would assist you in coming up with a credit decision, not things that you want to find out for your personal knowledge or for your own personal satisfaction. But always remember, it is with respect to finding out what you need to find out in order to determine whether you will grant the loan or not. So you need to ask relevant questions. In addition to that, you must listen, don't do all the talking. When you ask a question, really listen carefully to what the member is saying, because very often they will divulge things that may assist you in determining whether or not that you should actually be granting the loan. And finally, always remember your goal as a credit committee member. You are not there to 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 do financial planning with the member, although at times that is required. You are not there to do financial counseling to tell the member, well, let me kind of give you advice as to how to organize your household and stuff like that. What the member wants at that point in time is to know whether the loan will be approved. If you feel it is a case of financial counseling, then the experts, there should be people at the credit union who could do so. Or if the credit committee members themselves are skilled or have been trained in that, then you should reschedule another session to have the financial counseling done and not do the financial counseling at the same time that you are approving the loan. Now, don't misunderstand me. I'm not saying you cannot advise the person on something during the loan application or during the interview process, but financial counsel is a whole process itself. It's not just maths you're working out. You're really dealing with people's emotions, habits, behaviors, challenges, and stuff like that. So when someone actually wants to have a loan approved, they will agree to everything you're saying if you're counseling them, because their aim is to get the money. And that's why I'm saying it's not always appropriate to do the financial counseling at that point in time. Now, another thing we need to be very mindful of is our own biases, as I've mentioned before, when we are determining whether or not we will grant a loan. And let me just give an example, right? Um, if it is someone is married and has uh, family. Let's say, this lady is married, has an excellent husband, and he takes care of the family and stuff. And she comes in and say, she wants a loan to, um, let's say, I was going to say for an abortion, but let's make it a little simpler. Let's say she wants a loan to give it to her boyfriend outside of marriage, because the boyfriend wants a car and she wants to assist him in getting that car. Sometimes we may say, but boy, I can't do that, because the husband is my friend. um, I want to say that while morally you may have a problem with that, If it is not one of the C's in credit, and we will go to that afterwards, then it should not influence your decision to grant that loan or not. Whether the young lady is faithful to her husband or not is not the criteria to approve or disapprove the loan. The criteria to approve or disapprove the loan is really dependent on whether he or she, because it could be a man too coming in with a similar situation. And so it depends on whether or not you know that they can service the loan. If it is a good loan and they can service the loan, then your responsibility and your duty is to grant the loan. And so sometimes, as good Christian people, let's say, we may not feel comfortable about that. But as long as it is not an illegal request, as long as it is, and that's why I changed from the abortion, because sometimes that I'm not sure if where what line that crosses. But if it is that it crosses a legal line, that is where, like, say for example, if someone was to come in and say they want to invest in buying narcotics, that's totally different. That is an illegal transaction and you ought not to engage in that. That is different from something that you feel morally reprehensive. So just wanted to put that out there. So when you are approving the loan, so when you're deliberating on a loan, what you need to do is, in addition to the loan application form and the interview and the preparation of the interview, what you also need to do is to be guided by what we call the 5 C's of credit. And I know some of you would be familiar with that, but that's character, capacity, collateral, capital, and conditions. Now, when we say character, the example I gave just now is an example of character. I may not like someone's moral character, but that does not mean that their credit character isn't intact. You may see a young man comes in with a pants hanging, halfway down his legs and speak it in a kind of way that almost like a different language. But this person is very responsible financially. The person is permanently employed, has a good income, manages his affairs appropriately. Whether he or she acts in a way that you don't like, that is irrelevant. That has nothing to do. The person could be a cussbud, the person could be a limer, whatever. That does not matter. The character that we're talking about in the 5 C's of credit is what you call a credit character. Is he permanently employed? Does he have a good attitude towards his debt? Has he serviced his loans according to the agreement in the past? Is he stable and permanently employed, etc., etc.? Is the debt service ratio within the required guidelines? Has he been a long-standing member? Does he have adequate other things like collateral and stuff? And if that is the case, then the loan ought to be granted. So it's not about what you like or don't like personally, is what the information in front of you, based on the tools that you have to evaluate the loan application, tells you. So that's character. Capacity has to do with the abilities, with the person's ability to repay. Like I'd mentioned before, debt service ratio, as long as the debt service ratio is within guidelines, you may have the salary coming in, regular savings and stuff, the person could service the loan, they have the capacity to pay, then certainly. The other one is collateral. Collateral is simply the security that you're holding against the loan. Now, once the collateral is adequate, and collateral could be one that fully covers or it could be partially covers. But as long as you are satisfied with the quality of the collateral, then that is one of the things that you consider. Now, collateral can take the form of different things. Like, say, for example, and just to mention, like I said, this is not a training session, but I just want to mention it could be like fixed deposits, it could be like land, it could be commercial property, residential property, agricultural property, and they all take on different um, values, so to speak. So, say for example, if it's a personal property like a land in residential piece of land, you might tend to hold, I don't know, 80, 90% of the value of it. So say, for example, if it is the loan is valued, let's say if the land is valued, at 100,000, you may want to consider it to the value of 80,000 based on your loan policy. And your loan policy, that's why you should be familiar with it, should stipulate those things. From time to time, you may have a need to make it 90% because you want to grow a particular portfolio, and that's fine. Then you may have commercial property, and you might say, well, for commercial property, you will probably want to take between 65 and 70% of the value of the commercial property. And there's a reason for that. The demand for residential property is normally higher than the demand for commercial property. And the people interested in residential property, or the market for the sale of a residential property is much wider than the market for that of a commercial property. And so there is a lower level of risk associated with converting that asset to cash to clear your loan than it is for a commercial property. Similarly, agricultural property. If it is, you're looking at agricultural property, you may not want to look at more than 50% of the value because you don't have 1,000 people running around looking to invest in agricultural land. And so those are some of the nuances. If, say, for example, you have a fixed deposit, you may take 100% of that, you may hold as the value as collateral. But if it is you're looking at shares in a company listed on a stock exchange, you may only want to consider 2/3 of the value. So if the value of the shares, say, for example, is 100,000, to use an easy figure, you wouldn't want to take more than 66,000 in terms of the value that you ascribe to it. You know why? Because, as you know, on the stock exchange, things happen with companies, they fluctuate. Today it might be valued at 100,000, but something could happen in the company. They fire the CEO, the massive fraud, whatever, and the value of those shares dip from 100,000 to, like, say, 70,000 almost overnight. And so therefore you need to have a certain margin of cover to ensure that your members' funds continue to be protected. So that's collateral. Capital, and earlier on when I was chatting, capital really is the person's net worth. That is really what you want to look at. And what you want to do is over time have a sense of whether the person has what you call capital accumulation. Not just capital, but you want to know if over a period of time, the person's capital goes from, let's say, 100,000 to 125,000 to 150,000. What that shows is that the person is not only repaying his or her debts, but it shows that the person is actually growing in wealth. And so therefore, it gives you a better opportunity to hold more assets and to lend more and to grow your credit union more and also to help build the member more. So capital is important. Conditions also important. If the person, well, firstly, there's the whole economic condition of the climate of the country. For example, you need to take that into account. You need to have a sense of what is happening in that particular sector. If people are going to be retrenched or not, you need to know, say, for example, if of the person's personal conditions. And when I say personal conditions with respect to how it will impact credit worthiness. In other words, their ability to service the loan. So if it is their personal conditions, let's say someone is ill and is, let's say, terminally ill, and they have been given 6 months to live, and they came to you for a loan for 100,000 to do an operation that's going to ease the pain over the 6 months, but they won't be able to service the loan because they won't be going. Let's say even if the person lives for a year, you might be tempted to want to help the member, but remember, it is not about the way you feel about it. It is whether it is a good loan, and it's not your money that you're lending. You're actually lending other members' money. And so therefore the question you need to ask yourself is that if this was somebody, one of my neighbors, and I know that this person will not be able to repay me, and they're asking me to lend them my 100,000 that I've saved for my whole life, and I have my children and my wife to think about. would I take my 100,000 and lend this person, whether or not I feel, bad about the person's situation or whether or not I would like to help. And I'm suggesting to you that if you're not going to take your 100,000 and give it because you know you're not going to get it back, then you cannot give the members money to someone that you feel sorry for because you don't feel it's your money. You are lending somebody else's money. And so you need to be very careful about that, right? So there's some common mistakes that we all make as credit committee members. As I mentioned earlier, in the credit committee, your election to the credit committee is a political one. It is a popularity contest sometimes, and sometimes we don't want members to not like us because we want to be re-elected again. And so therefore, to some extent, you really want to be a little more lenient, especially with certain members who have a lot of influence on the flow. I'm saying that, your political ambitions is not one of the C's in credit, and that should not influence your decision. I know it's sometimes hard because it is a political process, but that is your responsibility. Sometimes there are members who continuously get onto the credit committee, and so after a while, they will, of course, develop more skill, and a certain amount of ego steps in because they know it all kind of thing, and there's no need for them to feel the need to train because you know what, they know all of that already. Additionally, you may have new members on the credit committee that may want to make a contribution, but because you so know it all, you're not listening to others, but that other person, as new as they may have other information that could bring to the table that could influence the decision positively or negatively, or they may have had insights from previous places where they have gleaned information that could be beneficial to everybody at the table. So I just want to say, like, because it's not a perfect science, we really need to be very mindful, especially for those credit committee members who there for the last 10 years. You need to be mindful and check your own self, right? The other thing is, and I mentioned before, you need to empathize but not sympathize. If you sympathize, you'll make bad decisions. And anytime you feel that you're doing a good thing by helping the man or helping the woman, I just want you to think about going into your own bank account and if you would lend the person the money. And if you really don't feel you could lend the person the money, then don't. And if you feel you could lend them by those satisfied, then I challenge you to go to the bank and take out your money and lend them. If you can't do that, then you can't lend them the members' money, right? The other thing is sometimes we tend to turn it into a math problem and feel that we could solve it by saying, you know what, that phone bill too high. He could cut it down from 500 to 300. It have better packages out there. And you see that food bill, you see all them thing he buying, he could go to the market and buy it in bulk. He could cut that down by 25%. And that electricity, why does he have on the air condition holder? That is nonsense. And so what we do, we go through the members' income and expenses, and that's the other thing that we need to have on the application form, in addition to the assets and liabilities. But we go through the income and expenses and we kind of try and make it fit like a math problem. I just want to say that it is not math. People's livelihoods, their styles of living, the way they organize themselves, very often are embedded in who they are. And as such, they really find a lot of difficulties in making that adjustment. And I'll tell you something. The only thing that's worse than deprivation is relative deprivation. Let me give you an example of that. I live in what I consider to be a normal middle class home, right? No big lavish things spread over any acres of land with all sorts of fancy anything. But I'm quite happy. I am quite happy. And as far as I'm concerned, I good to go. But you know something? If Jay-Z or Beyonce come to live here, they will be immediately become very depressed because relative to where they are, to where I am is chalk and cheese. And so that is something that we need to bear in mind. And if you think that that's a ridiculous example, then take where you live right now and how we live right now and say, you know what? I am now going to have to go and live where, let's say, in Ibiza. And so when these trucks come in with garbage, my way of generating income is to go and kind of marshal a garbage truck, fight off some of them other brothers and say, this truck is mine. I had to go through here, and wherever I get here, I go in and sell. Because there are people who live like that. Now, if you were to go and live like that, relative to where you are, to where they are, you will become immediately depressed. But you know, they are not depressed. And we are not depressed. And Beyonce and they not depressed because this is a lifestyle we've grown used to. So I'm saying, and similarly, when you ask people to adjust the way they live, you're really putting them in a relatively deprived position, and that could be pretty traumatic. So just those are some of the mistakes that we make. Over familiarity with the borrower is another thing. You know, sometimes a man always coming in and he want to borrow a small amount of money, especially for permanent recurrent expenditure, and we keep doing that because he has been a long-standing member. He's a good member. He does save, and it's fine. But you know what? If I coming in every month or every 2 months for things that are on a monthly basis, I need to pay the light bill, the phone bill, the this, the that, the other, then it says that something is wrong. And those are the situations where you need to refer to a financial counselor because sometimes the underlying, and I'm not saying that you may not approve the loan because it might still be credit worthy, but you may want to recommend financial counseling. And as part of the approval, you may want to send the person for some kind of counseling by a counselor who could go through the process with them. Reason being is because when you do that, you may end up having, if the person is not qualified, you may end up um, hurting the situation more than helping. So you need to refer them to a qualified counselor, so to speak. Because when they go there, they're not applying for the loan. That part is already dealt with. They're looking to address in an appropriate way whatever lifestyle changes they make. That's a whole different skill set. And so you need to be able to have someone who could assist them in transitioning that process. Now, having said all of that, if it is you do not lend money appropriately, there's a lot of fallout when it comes to delinquency and the ill effects of loan delinquency. Now, let me just give an example. If I lent you $100 and you pay me back $100, then I don't gain or lose anything. I lent you 100 and you gave me back 100. But when I charge interest, I say, okay, I'd lend you $100 and I'll charge you 10%. So you have to give me back $110. Now, the $100, as you know, is not profit. The profit is the $10. And it is that $10 that is used to generate money because that is the income you use to pay your salaries, to pay your operating expenses, to pay dividends, and to do and also to reinvest in loans to members. So if I lend you $100 and you give me and you do not repay the loan, then in order for me to generate $100 in income to write off that $100, I need to lend $100 10 times at the same rate of interest just to generate the money to write off that loan. And that is something that we need to look at. And that is not taking into account any salaries, any dividends, any operating expenses, any growth in the portfolio. So when you see you pay a dividend of 5%, it means that you need to lend for every $10,000 you write off, you have to lend 20 times that in order to generate the income to be able to write that off. And that is how you need to look at it because sometimes we feel that the credit union big, where's a little 10,000? No, it is what is required to generate the revenue to write that off. And so the job and the role and the function of a credit committee member is very critical. And I'm hearing that someone want to say something. Anyway, and I want to say that at the end of the day, when a credit union fails, loan delinquency is almost always at its heart. And so, therefore, it is a very critical function that you're signing up for. And I want to humbly suggest to you that you treat it with the respect and the dedication and commitment that it requires in order to ensure that your credit union continues to grow and be successful. Now, and that is essentially the discussion that I wanted to have with you all this afternoon. I know it's almost an hour. Um, if you all have any questions, feel free to ask. If you all have any queries or concerns, even about what was said, feel free to ask or bring it up.
Thank you, Mr. Patrick. I would like to start off with the first question. In selecting a credit committee, would you advise to have persons with background in credit, or would you advise to have persons with fresh minds that could go through a training process as to what it is you would require of the credit committee? Because I understand sometimes it's hard to unlearn certain things, which is what you did speak about in terms of persons that have served for more than one term or so on, that may feel that they know everything. So what do you suggest in terms of what to look for when selecting members of the credit committee?
That's a very good question. And my response to that is that either could work because you do need experience, but you also need fresh minds. I think what is required for both parties is a willingness to listen and to learn. So, say for example, for the person that's coming in with new ideas or with that and that has just gone to a training program for a weekend and came back with all these great ideas, that is good. But then they should also have some, what should I say? I want to say respect for those who have been there before, because nothing beats experience, right? But on the other hand, for those of us who are experienced and who have been in credit for a long time, we also need to listen because you never know when a situation or when there's some nuance that you really did not think about. Let me tell you the reason why not only credit unions but banks and other financial institutions have credit committee as their ultimate lending arm. And the banks, the commercial banks have lending committees, investment banks have lending committees, credit committees. The reason for that is because it is not a perfect science, and because we don't always see it the same way. It makes sense to have different people come forward with different ideas. But what is important is that we must all be receptive so that we listen to it in a manner that is open so that it can add value in making a superior decision. So my response to that is both can work, but you need an open mind on both sides. Any other questions?
Yes, Mr. Maxwell, your hand is up. You can go ahead and ask your question.
Yeah, good evening, everyone. Mr. Cole, I listened to you carefully, and I don't want to contradict anything you have to say because it has been said on a wealth of experience. But these I think especially with younger people, any type of changes that I've recognized throughout times is that one of the things that came to me as a credit union member was basically the importance of paying loans. For everything, the credit union cares that the member pay loans. And I believe that in Kasha Credit Union, with the type of situation going on today, because At my age, I get to realize, even at my age, government take more than 50% the salary in taxes. So when you're working, look at in tax, that's collecting your salary. How much the government tax, and the rest is your salary. But what I get to realize is your salary becomes the money you have at hand when you pay all the things you have to pay. And that includes your food, your light bill, and all these things. And eventually, they're not very small because your taxes, the government is in everything. I'm trying to go to that direction, right? And then I will give an example.
That's okay. Yeah.
So shares and loans today could crash a credit union to me, because I see it happen in other cooperative societies, all right? And the other one was debt service ratio. Throughout my lifetime, I heard a lot about debt service ratio, and it's something the banks are very strict about. And thank God for credit union, because I was able to adjust my salary around and clear my debts, and actually make my liabilities my assets. And I will go to the next one, which is assets and liabilities. As a young person, you end up with a lot of liabilities. Only becomes the asset when it's no longer a loan. Nearly anything you buy that's inherited is a liability. And the sad thing about that is that when you have these liabilities, and instead of you go to a financial institution that could pull you out, which was real advantage of the credit union, actually end up going by money lender. And this is where a lot of people will come to the credit union nearly every day for money borrow. Because from my experience, they had been visiting money lenders. So, I mean, based on the topic that they speak about, I think the credit union have to look again, because in the earlier times, what I worked with credit union, my understanding was shares, because I always tend to lift my shares in a way I could use my shares, get myself out of a loan with my salary. And the nice thing, I see the credit union did it recently, and I say, what? They're getting brave. Because I see they had an offer of $400,000 in line of credit. And when I listened to it carefully, I said, that is very smart. Whoever comes with that idea is very smart. But I mean, when we hear it and we visit the credit union, then we'll understand it. But these points I'm making is because the younger people, I'll give an example. When I went to college, it was this guy, all he cared about is buying a Ferrari. I mean, buying a Ferrari. So that was selling chassis in a year. And why you want to buy a Ferrari? But he did buy a Ferrari because his study had caused him to come in a very good income. And then he came a little while after I knew him, and he said, you know, I don't want to park my Ferrari. So then he had to look for property. So in a way, it's how different people do it. I speak in a barber recently, and he said, I don't want a house, you know. I want plenty land. I want about 5 acres of land or 10 acres of land. So younger people think differently to me in my times, because in my times, I want a house for my family, I want a car, job them, go to work, and so on. And these liabilities, as you meet your daily expenses, they will only come in assets after 20 years, or maybe after 30 years. You know what I mean? Or you sell a car and buy the next car, and you get a better car. At one time, I told the credit union, and I said, why are we encouraging members to buy all these cheap Japanese cars? When I went to Agriculture Development Bank to buy a vehicle, they tell me, oh, buying a Hilux. I look for one of them cheap vehicles that I could just transport. And I didn't get my loan because it was a cheap vehicle. So, I mean, I understand what you're saying, but I think credit unions need to look a little closer to how they are dealing with present day clients. Thank you.
Okay, I just want to say thanks for that contribution. But there's several things you raised, and I just want to chat a little bit about what I can recall. Firstly, I want to say that, like the young man who wanted to buy a Ferrari, remember it's 5 C's in credit, huh? Not just one. It's character, capacity, collateral, etc., etc. Now, if you're buying a Ferrari, the Ferrari will be of a certain worth, and you may ask for a down payment of 5-10% depending on your loan policy. If that young man has a job that allows him to buy a Ferrari and pay for it, then certainly, then you should grant the loan. If he has good credit history, good job stability, good income, and you're holding the Ferrari as security, then you might decide to lend them. Nothing is wrong with that. Whether you agree with if you should buy a Ferrari or a piece of land, that is where the personal thing comes in. But in terms of credit worthiness, nothing is wrong with that. Absolutely nothing is wrong with that. Secondly, if it is that someone is young and you're starting off, and you're quite right, unless you inherit something, you don't start off owning assets. You may start off saying, listen, I have a 10,000, I want to pay down. There's all I have, but I want to pay down on a piece of land. The land is worth 100,000. And you might say, well, okay. And you might put the 10,000 on shares, you hold the shares and you hold the land that worth 100,000, and you lend the person the 90,000 or the 100,000 for the land, and you hold the land as security. Again, absolutely nothing is wrong with that. As long as the person has the capacity to pay, the collateral, the conditions are right, and you look at all the C's of credit, then certainly in 10 years' time, the loan will be repaid, the land might be worth 200,000, and the person might even have 20,000 in shares. And so therefore the person would have enhanced their capital position and qualify for even more loans. That is not the same as when you evaluate someone's net worth. That person's net worth will continue to grow over time. And that's why we mentioned capital accumulation. If the person is doing it right. But if the person is coming every day for loans, so permanent recurrent expenditure, like your light bill, your phone bill, your WASA and that, you will find that it suggests that the person is having difficulties meeting their normal living expenses on a monthly basis. You'll find that the person does not have the ability to save. You might find that the person will eventually end up not being able to service the loan, because as they keep borrowing, their repayment keep getting higher, and so they're putting themselves in a debt trap. And so you will need to evaluate that differently. So every loan application ought to be evaluated on its own personal merit, and the reason why I use some of those examples is for the same reason. I don't want us to knock the young boy, nor do I want us to on one hand, because he or she might be good. And I don't want us to feel that because somebody driving a Mercedes Benz, that they are good. They may not be good in terms of a credit risk, but as well as they could be. So all I'm saying is the reason why I gave those two examples is so that we do not get caught in our own bias and we evaluate it based on all these C's. And I'm certain that if you look at the C's in credit, you will know whether you would lend the man for the Ferrari, or you will lend the man, or the young man who wants to buy land. Nothing is wrong with that. Nothing is. So I don't disagree with you. What I'm saying is use the 5 C's in credit to make the determination. That's what I'm saying. I don't know if I've answered you, but that was my understanding of what you said in response to the discussion that we had.
All right. I appreciate what you said because we stick into the credit committee.
Yeah.
One of the things that I wanted the credit union to look at also, especially the credit community side, based on what you are saying, is that before any credit union we did not have the privilege of things like insurance and FIP and so on, which also would add like a tax to their salary, because these are liabilities. These are, you have to pay them and keep paying them in order to keep them. And I believe maybe the credit committee have to look at things like that. And I'll tell you why. When I was much younger, and I go to the credit union, and I'm talking about Tranquility. Tranquility is a total wonderful experience. I was in credit union at I was grade 8, which was not Tranquility. And one thing was happening, for some reason, the credit committee was sort of just not jostling, but say, let's say, example, we had to lend out $20,000 this evening. And you're going to a credit committee, and you might want $5,000. They have about 10 people coming in for loans. And what they tend to do is say, all right, you can get a loan and we can get $3,000. Those things, some of the worst things could happen to you when you go into a borrower. I could tell you that from experience. And that was the difference with Tranquility Credit Union and some of the other credit unions I belong to. Because either the credit union can give you the loan, or they can't give you the loan. But one of the things I see have been practiced by credit committees, and again I will bring in here loans officers, and we have now in our management loans officers who really somehow or the other believe that it could function a credit union like a bank. And these are things that I feel as members, especially on this committee. And this is why I pay so much attention to these three meetings that we had, these three areas that we statutory bodies that we hosted, because those information are, sorry, it's only 12 people we have here. I wish we had something like over 40 or 60, about 200 people, because these are the knowledge that is important to the credit union members. And they take it for granted, and they would crash our credit union if we allow certain things to continue. Like, for example, there must be an annuity, because if you started and you stop, you lose it. There must be an insurance. If you started and you stop, you lose it. Those are liabilities we must pay. And when we come to the credit committee, we're not looking at those things as part of our expenses. Anyhow, thanks, Ellen.
Okay. I mean, a good observation again. People tend to, now firstly, a credit union is not a bank. Credit union lends to its members, and when profits are generated, it is redistributed throughout the membership. And so that is different to a bank. When a bank generates profit, it doesn't go towards the people that borrow from the bank and patronize the bank. It goes to those that own the bank, that own shares in the bank. So it's a fundamental difference. In terms of the philosophy, yes, I think the credit union movement over the years, and I too have been around for quite some time, I think we have drifted to some extent in terms of understanding or spreading the philosophy of what we are about. The credit union system or the cooperative philosophy is really a superior philosophy, but that does not mean that we must not grant good loans. And so that is the balance that we need to strike. We have components like the education committee. We set up counseling, personal financial planning, do training for members. Even this very session we're having, these things are very important so that people begin to understand what we are about. I mean, we weren't dealing with the credit union philosophy. This is the credit committee. And so the discussion was kept focused on credit appraisal and the importance of it and the ill effects of delinquency and that kind of thing for people to understand the significance of what they're looking to engage in. And that's why it's important to have training and retraining. But what you're talking about, there's a whole philosophy. And so it is important when you bring in new people that you train them in the philosophy of the credit union, however, or the cooperative philosophy. However, that does not mean that you're going to just feel sorry for somebody because is somebody that, as credit unions, we don't move so. Because, and that's why I gave the example, if you can't give your own money, then you can't give my money, because it's my money you're lending that member. And you know the member can't repay it. So not because you feel sorry, because your responsibility is a collective responsibility. The credit union has 30,000 or 20,000 members or 10,000 members. You're there to serve that 10 or 20,000 members. You have a collective responsibility. And sometimes you may have to turn down an individual in the interest of the whole. And so those are things that we need to understand too in terms of the philosophy. Now, I have no problem if a credit union decides to have a charitable fund or a charitable foundation, and some credit unions have done that, and they have made contributions to members who have been there all the while, but that's something that passed in a budget that they agreed to and they have guidelines for. That is not a loan. That is a grant. That is charity. But as far as a loan is concerned, whenever you grant that loan, your aim is to ensure that it is repaid with interest so that you could take that, grow the credit union, and provide better quality products and services to more and more members. Now, that said, that the leadership of the movement, maybe could do a little bit more in terms of preaching the philosophy and the superior of the philosophy, the cooperative philosophy, to its members so that people are more committed to it. Now, at the same time, the youths and them going after technology because the way they do business is different. If, as credit unions, we do not get with the technology, what will happen is that we'll have an extremely aging population of people who can't take loans. And if you remember, you're a man like me and you're up there in age, and you now remember the days of the friendly societies. There's a time when the friendly societies they were it. Where are the friendly societies today? And so we now need to take into account our growth in comparison to the growth of other financial institutions out there and understand what the needs of the youths are and incorporate those needs into the cooperative philosophy. It is a challenge, but those are the things that we need to start doing. We can't just say that this is the old way and this is the way it has to be done. Because if that is the case, then we will all migrate into that ripe old age and become like the friendly societies. So again, it's a balance. It's like the older member and the newer member in the credit committee. We both need to listen to each other. So I hope that shares. Go ahead.
Thank you, Mr. Patrick. In the essence of time, we want to take one more question, and that is from Mr. Ken Jarvis, who has written in the chat, do you have any knowledge or info on the credit union and the credit committee and e-money connection at this time?
The short answer to that is not really. I know that many credit unions and other financial institutions are thinking in terms of having those things. I know that several credit unions have been approached by providers of this service to have a e-wallet that they can use, that you could approve loans and do it through this mechanized process. I know that some credit unions have been looking at it. I'm not sure where it's at. The best place to find that out would be at the Credit Union League or maybe the Central Finance Facility. I know of a few credit unions that have looked at it. But in terms of where it's at, no, I don't know. I honestly don't know. But I know that it's around, and that is something that we will eventually have to look at. Whether we should take the lead in it, I am not so sure. But we certainly need to at least have our younger members be able to access loan applications and stuff online and through their phones and stuff like that. Those are the things that we need to be working on, because that is the way they communicate.
Yes, agreed and understood. All right, Mr. Patrick. Now I would like to ask Ms. Allen Benjamin Are you online, Miss Allen Benjamin? Miss Annalisa, are you here? Okay, she seems to not be here, so I will deliver the vote of thanks to you, Mr. Patrick, because you have been very engaging in your session. We'd like to thank you for taking the time to be with us today and to embark upon us this wealth of knowledge that you have on the credit committee. I can say for myself, and I hope I speak for all of the persons on the call today, to say that you have educated us in more ways than one. And we look forward to having another session with you in the future to be able to gain more knowledge as to different roles and functions of the credit union and the credit union committee, the credit committee in that, because I know there are a lot of things that you may have left out in the essence of time, but we do appreciate the information that was disbursed today, and thank you for having us. Yes?
Okay, I just want to say you're most welcome, and it was certainly my pleasure.
Okay. Thank you to all the members of the directors, the committees for joining us today. This is the last session of our three-part series where we would have discussed the functions and rules of the board of directors on Tuesday. Then on Wednesday, we would have done the supervisory committee, and today we closed off with the credit committee. All of these sessions were recorded and would be available to members for review within the future. And we thank you once again for taking the time out to be with us today, and hope everyone enjoys the rest of their night. Be safe and have a good night.
Okay, thank you.
You're
Thank you.
welcome. Good night.